Hershey's has been down as low as 35% since its peak in May of 2023. But what does it mean? Maybe it was just massively overpriced, or maybe it's currently a great bargain, or maybe there's a fundamental problem with the business. Well, let's analyse Hershey, ticker symbol HSY, and try and find out if it's a great opportunity or a value trap. Let's start by looking at the key metrics. Price to earnings ratio. This is a valuation metric that compares a company's share price to its earnings per share. Currently this is at 20.04 and we want it to be under 20, so this shows the company is quite possibly fairly priced. The S&P 500 is currently priced at 23.5. This is a large cap company, but we need to consider if it is capable of growing further, or will this company remain stagnant? According to Morningstar, Hershey's has a wide moat and identifies this as a highly competitive market for companies that provide snack foods. The earnings per share for the trailing 12 months represents how much money a company makes for each share of its stock. This shows that for every dollar Hershey spends, it is generating $9.36, which is terrific value, and has grown by 17% year on year. The free cash flow per share is where the company uses the money it generates to either repay its creditors, buy back shares, or issue as a dividend. At present, free cash flow per share is 7.94, which is down 10% from last year. Revenue is the money generated from the business's operations. Hershey's revenue is 54.71, which has grown 8% since last year. The book value per share, which is also known as the company's equity, the ratio is calculated by dividing the equity available to the shareholders by the number of outstanding shares. This is 19.46, which is an increase of 21% since last year. The average equity growth for Hershey's over the last 10 years is also 21%. Individual insiders are people who work within the company and therefore have a vested interest in the business doing well. Joel Greenblatt says never underestimate incentives. He reminds us to always check and see if there's been any heavy insider buying or selling. It is important to monitor this, as it can indicate if executives believe the stock will rise or fall in the future. We can see that no insiders have recently bought shares in Hershey. However, an insider sold 180,000 shares in April at $260 per share. In the grand scale of things, these particular shares being bought or sold don't offer too much insight, as the shares being bought and sold are quite small. There are currently 3 super investors who own this company: Donald Yackman, Michael Lindsell, and Nathaniel Simmons. Recently, Nathaniel Simmons bought 1,176 shares at $199.83, which equates to $235,000, but this is only 0.1% of his portfolio. Here we look at the past historical prices of the company. Hershey's has a 5-year low of $95 and a 5-year high of $324. Therefore, its average is about $184. In a 52-week low, the lowest price was $179. At 52-week high, it was at $277, meaning its average price last year was $228. Hershey's has a market share of about 4%, meaning that it's in an extremely competitive area. Let's look at the key metrics for shareholders. Return on invested capital is a calculation used to assess a company's efficiency at allocating capital under its control. This is at 22%, and we would like to see anything above 10%, so this is very good. Return on capital employed is a financial ratio that can be used to assess a company's profitability and capital efficiency. Again, we want this to be over 10%, so 26% is very good. Return on equity is a measure of financial performance calculated by dividing net income by the shareholders' equity. At 48%, this is also an excellent return. Free cash flow yield is a financial solvency ratio that compares the free cash flow per share a company is expected to earn against its market value per share. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability than traditional earnings or dividend yields. It's based on the actual cash a business generates rather than reported earnings, which may be subject to various accounting adjustments. He typically looks for companies which have a free cash flow yield of 5% or higher. So, at 4%, this is still a very healthy free cash flow yield. Gross margin is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. This is at 45%, and we want to see this at least above 40%. Next we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for variable costs of production, such as wages and raw materials, but before paying interest or tax. Hershey's operating profit margin is 23%, and we would like to see this over 15%, so this is very good. Then we have debt. Phil Town prefers companies that are able to pay off debt with their free cash flow within 3 years. In Hershey's case, this is very slightly higher than 3 years coverage, but still within acceptable tolerances. Lastly, we look at short selling and see if traders are expecting the share price to drop. So anything that is over 5% we would tend to avoid until any volatility has settled. At 1.34%, this suggests traders are not overly shorting the stock. At this point, let's look at what the analysts are predicting about the future of growth. They forecast the share price to be as low as $180 and an average of $235 and a high of $285. They estimate that the earnings per share for 2024 and 2025 will be 6%, and that in 2026 it will be 7%. Ideally, we would like this to be 10% on average. To properly value the company, we will have to work out the future stock price of the business. We do this by looking at the current EPS and then project forward what we think the growth of the company will be over the next 10 years. And we will do this for the EPS and the PE ratio. We also want to factor in the return on investment, which Phil Town recommends being 15%. So for Hershey's, using an EPS growth of 16% and a PE value of 32, we come to a future stock price of $337.69. But then we want to include a margin of safety, which is an investing practice first pioneered by Benjamin Graham. It involves purchasing securities when their marked price is significantly below their intrinsic value. A margin of safety of 50% is very conservative, but as Warren Buffett says, Rule 1, never lose money, Rule 2, never forget Rule 1. Hershey's with a 50% margin of safety comes up to $168.85, so ideally we would like the share price to drop just a little bit further. Let me know what margin of safety you are prepared to use. Lastly, we'll look at payback time, which is the amount of time it takes to recover the cost of an investment. So, based on the free cash flow, it will take 10 years, and based on the EPS, it will take 9 years, and ideally we want this to be no longer than 8 years. The potential return for Hershey's, based on the 52-week average price of $228, is 24%, whilst the 52-week high has been $277, which could be a 51% return. Hershey's pays an annual dividend of $4.30, and this has grown 13.61% since last year. Therefore, the payout is 45%, and we want this to be between 20 and 50%. So, let's review the pros and cons of the company. The pros are the current price and valuation. The shareholder metrics such as return on invested capital and return on capital employed, their gross margin and the profit margin. This is a well-managed company, and Hershey's is aware of the need to include healthy snack options in their portfolio, and through acquisitions it has bought companies that can aid them with that. However, analysts believe Hershey's will only grow on average at 6% over the next 3 years. Its free cash flow is 10% lower than last year, and Hershey's exists within a highly competitive space. What are your thoughts on the company? Is this an opportunity for you to own part of the business, or would you rather wait for a better price? Or would you rather avoid this company altogether? Let me know in the comments section. Thank you for watching, and I'll see you in the next one.